A huge tech company in New York just radically ditched their entire 401k matching program and adopted a completely different kind of benefit that many of their employees raised their eyebrows. And many financial advisors, financial planners, and financial coaches like me question and kind of worry if employers ditching their 401k match will become the norm. USA Today actually was the first one to report about how IBM is switching its 5% 401k match and 1% automatic contributions into what's called a new retirement benefit account, or RBA, starting on January 1st, 2024. And I will link the article in the description below. So let me explain to you what this means to you and if other employers could start following suit. And let me know in the comment section down below if ditching a 401k match is a good idea or a bad deal. And I'll tell you about my opinion towards the end of this video.
Stick around.
So let me summarize what IBM said they're going to do. IBM is putting their employees' 401k match, not the personal contribution, to a traditional defined benefit contribution. And CNBC is also reporting that other companies are considering creating a similar plan, but none of them have a timeline like IBM does, which is starting on January 1st, 2024. So under the new plan, IBM employees can still contribute to their 401k plan with personal contributions up to the IRS limit, which is $23,000 for the year 2024, or $30,500 for you guys over the age of 50. However, IBM will no longer provide a 5% match and a 1% automatic contribution to the employees' 401ks. Instead, it's going to a retirement benefit account, or RBA, which is essentially the old pension plan. Employees with RBA will get a guaranteed rate of return, but one that could be much lower than what they could get by investing the money more aggressively. Again, this is just the employer match portion of the 401k. So the company will put 5% of the employee's gross salary into their RBAs and guarantee an annualized return of 6% interest through 2026. After 2026, the RBA will earn a rate equivalent to the 10-year US Treasury yield with a 3% per year minimum through 2033. Wow. And IBM also released a statement that, and I quote, "Under the plan, IBM bears 100% of the risk and must be prepared to pay the benefit at the time of employee separation," unquote. And IBM is able to pull this off because they already have a traditional defined benefit pension plan in place. This is going to be difficult for many other employers, companies to follow suit that may not have a pension plan in place for their employees. This is also an interesting move by IBM because they were one of the lead advocates to make 401k a reality back in the 80s and 90s. So 6% sounds really nice for 2024, 2025, and 2026. But starting in 2027, the yields could be as low as 3%. The employer match portion of their 401k could be very risk averse, but you can do something about your personal contributions. If I were an IBM employee, I would take a look at my 401k portfolio and figure out how much my employer match makes up the total portfolio. And let me give you some examples. So let's say I make $125,000 a year with IBM. And if I contribute 10% of my income to my 401k, that's $12,500 going into my 401k every year. Since IBM will put 5% of my income into the 401k RBA, then that's $6,250 going into a separate pot of money. So let's assume that it is 6%. By the end of 2024, that $6,250 will accrue interest and end with $6,625. By the end of 2025, the balance will be $13,647.50, assuming that the income stays the same at $125,000. By the end of 2026, the balance will be $21,091.35 with another 6% interest. But starting in 2027, the balance could grow at a minimum of 3% depending on what the 10-year US Treasury is doing. So this may seem like a good deal for the first 3 years, but it may become a bad deal if it only accrues 3% between 2027 and 2033. And for the personal contributions, with $12,500 going into the 401k plan every year, and that's the 10% of your personal income, that could be performing 6%, 7%, 8%, or more, depending on the stock bond allocation. I don't need to do the math here and show you that it will probably perform better than the RBA I just showed you right here. So to sum it up, their personal contributions will still go to either traditional or pre-tax or Roth. And they will still have the option to invest in equity or bonds. And how their 401k mutual funds perform will depend entirely on the market performance. We could see what happened in 2019 with almost a 30% return, or maybe what happened in 2018 with a negative 6% return. We don't know that. But what we do know is that the employer contributions will be tax deferred or in pre-tax dollars. Employees will receive what's called a monthly account credit up to IRS limits if they've been with IBM for at least a year. The first 3 years will have a guaranteed 6% return every year. From 2027 to 2033, employees will be guaranteed the 10-year US Treasury yield with a 3% floor. So that's a minimum of 3%. But from 2034 and beyond, employees will get whatever the 10-year treasury yield is, and who knows what they will be 10 years from now, right? It could be as low as 1%, it could be 2%, it could be 4%, or maybe back up to 5%. But what I really need to pay attention now is the overall allocation. Am I too conservative with my personal 401k contributions? Am I already doing 80-20, 70-30, or 60-40 allocation? This is not by any means any form of financial advice to you, but this is what I would be thinking about if I worked for IBM or a company that does this type of investment with my retirement plan. For example, what if I had 80% stocks and 20% bonds in just a personal portion of my 401k, and the other 50% of my 401k portfolio is already in a fixed income or bond-like investment? So out of the $18,750 that I have going into the 401k every year, only $10,000 or 53% is going into stocks, 13% is going into bonds, and about 44% is going into RBA. And that's going to make my IBM 401k portfolio a lot more conservative or risk averse. And I could be missing out on the opportunity to grow more. So here's what I would probably do in this situation based on my age and risk tolerance. But before I go into that, if you're interested in joining my private client program to get financial coaching and financial planning services, you can schedule a free consultation with me by visiting firesidechat.com/coaching. And I also recently launched a brand new website where you can sign up for a free membership to get your free financial resources by visiting firesidechat.com/resources. You do not need a credit card to apply whatsoever. These financial resources are absolutely free for you to use. So let me make the math simple for everyone to understand. If I had $5,000 going into the RBA every year from IBM as an employer contribution, and I had $20,000 going into the 401k investments every year, then I would just put all $20,000 into equity or 100% stock investments, because the other $5,000 is going into bond-like investments anyway. So if I look at the total 401k portfolio, that $5,000 or 20% would be in the bond-like fixed income investment, and the other 80% or $20,000 will be in stocks or equity. And I would definitely consider taking on more equity exposure or more risk, because I don't want to be too risk averse at my current age. And I don't want to settle at a 6% return, but I want to have an 8, 9, or 10% average annual return with the 401k. Because I have to keep in mind that every 401k has some type of management expenses. It could be anywhere between 0.5 and 2% in management expenses every year. So I want to make sure that I want to maximize the returns every single year. I know some of you would oppose what IBM is doing to their employees, but I think this is better than nothing, because there's absolutely no legal obligation for IBM or any employers to offer an employer contribution to their employees' retirement plans. And I'm glad that they provide 5%, because that is going to make a significant impact on every IBM employee's long-term retirement plan. However, and this is a big however, this is not necessarily a good thing for people who are trying to maximize their 401k returns every year. 6% is generous, but it's only for 3 years. After that, we don't know what the 10-year bond yield will do. It could become the biggest lagger in the IBM employees' retirement portfolio. And besides all of that, I personally wouldn't like my employer to dictate how I diversify my retirement portfolio. IBM wouldn't know my risk tolerance and my financial goals. Maybe I'm more risk tolerant than the other employees I work with. It shouldn't be up to the employers to decide what type of portfolio diversification is right for their employees. And I wouldn't be surprised if other companies start doing this to improve their cash flow by just crediting accounts instead of funding them using real dollars. But how soon this happens could be some time. Do I support the RBA? I do not. I think it should be up to the employees on how their retirement assets are invested. So let me know what your thoughts are on what IBM is doing for their employees' 401k plans. Do you agree or disagree? And this has been another beast of a video, and I hope you got a lot out of it.